Welcome to the Land to Lots podcast, powered by Launch Development Finance Advisors. And now your host, Carter Froelich.
Hello, everyone. This is Carter Froelich, and welcome to the Land to Lots podcast. In this episode, I'm really excited to be discussing what we believe is a massive innovation in the funding of public infrastructure in Texas. And it took us about 3 years to develop this structure. And I'm going to be talking about the transaction that we closed on June 28th of 2023, because I think once you understand what this transaction is, how it works, and the journey we took to get here, it'll become very clear to you why this is such an important financing tool. Before we get into the nitty-gritty of the financing that we're going to be discussing here, I wanted to take you on a little journey of how we got here and what our thought process was and our clients' thinkings and how we worked collaboratively together with our clients and others in the public finance arena to develop this new financing mechanism. But as you all are aware, our firm, Launch Development Finance Advisors, has been working with the private sector since the mid-'80s, when I got my start in Southern California doing community facilities districts. Over the years, we've set up offices all around the country. We continue to have offices around the country and work exclusively with the private sector, financing public infrastructure, primarily through the use of tax-exempt bonds, utilizing the various statutes in the various different states to help our clients offset the rising costs of capital. Now, over the last couple of years, we've all been challenged with rising interest rates. The rising interest rates have caused a lot of the traditional lending sources to pull back on their willingness to lend on acquisition, development, and construction related to residential master plan communities, which is really, where most of our work is done. On top of that, we've also, all of us, that are in this arena have had to deal with all of the bureaucracy that is thrown up by the state statutes, the jurisdictions, their policies, and just the processes. And here again, some states are better to work with than others, but some of them can be really, really quite challenging. So with this, as background, they say necessity is the mother of invention. And we started thinking of, boy, given the fact that the traditional lenders are pulling back, given the fact that infrastructure costs are rising, it's really challenging to make financings work in a meaningful manner where we can have long-term financing structures apply to what in our world with the master plan communities are long-term projects. And the traditional lenders have always been saying it's 3 years term. We'll give you 2 6-month extensions as you're paying back your loan. We want an accelerated payback period. So a lot of our clients were challenged in that as they were selling their initial phases of lots to builders, they weren't able to bring any capital to their bottom line and show any net income. It was all going back to the bank. So with that as a background, I started looking around at all the various tools we had in the different states. And for lack of a better term, I MacGyvered a concept whereby we could utilize conduit agencies, traditional lending structures, as well as special assessment bonds to cobble together what we call the land secured launch bond. And we didn't know what to call this thing because it had never been done before. So we just thought we'd call it a land secured launch bond. We ran this concept by and it just happened to be a Texas master plan community developer with a large project in the Austin area. And they believed in it, this concept that it could work. Now, our client's project was 500 acres. It was roughly 1,600 units. It had a municipal utility district or a MUD established on it. Our client had a $35 million revolver in place, and they really wanted to have 50 million net to them available to build offsite water, sewer, roadways, phase one improvements, do their grading, and build a very large amenity center. And $50 million was the number they were looking for. So with our initial concept, we put together a land secured bond issuance that we went out to the public markets. Now, given the timing of our clients' ask of us to move forward to secure this financing, given the fact that their goal was secure to $50 million, and they wanted to, as much as they could, push out the term of the financing so it wasn't like a typical bank, meaning 3 years. It was something much larger than that. And so we structured a transaction, $64 million transaction, secured by first deed of trust, or very much like an assessment bond on the property, whereby when the builders closed on their property, and I should mention that there were 3 builders that had purchased all 1,600 lots. They were taking those down on a roll, and they roughly, assuming that they closed on the lots in pursuant to contract, they would have closed and purchased all of the lots within a 7-year period. So with this as the background, we put together, working with the underwriters, a $64 million bond issuance. It really looked like a PID in Texas. So it kind of looked like an assessment bond. However, we did not go through the county. We did not go through the MUD. We went through a separate agency, and we were able to find a purchaser for all $64 million that would have allowed our client, when you just kind of cut to the chase, $50 million in construction proceeds, roughly, assuming that the builders took down the lots in accordance with their contracts. 2 years of capitalized interest would have allowed our clients to finance all of the infrastructure that they wanted. The bond buyer, however, came back and said, listen, we would really like some sort of structured payments. We would like to set up a payment schedule that kind of follows the takedown schedules of the builders. And we would like to put a final maturity on this bond of 9 years. So there was a final maturity of 9 years. We had originally set it up as a cash flow bond. And the interest rate that they came back with was in the high nines. And we had been anticipating that this interest rate would have been 8%. However, when it came back with a yield in the high nines, our client said, well, we like this idea, but this interest rate is higher than what we care to pay. So they decided not to move forward with this transaction. So why is that important? Well, it's important for 2 reasons. Number one, it kind of set up a structure for us that we could potentially use to go out, and rather than issue taxable bonds, and I forgot to mention that this was a taxable transaction that was sold in the high nines. And the reason it was a taxable transaction is we were financing a lot of private infrastructure, meaning the amenity center and the grading. And given our clients' need to move quickly, we didn't have the time period to try to figure out how we could do it on a tax exempt basis. So this was, when I say high nines, that was a high nine, a taxable bond. So fast forward, lessons learned, we said, okay, we got a structure that appears to work. The things that didn't work is our interest rate's too high. Is there a way for us to potentially lower our interest rate? And two, what are the steps that we would have to take to potentially allow us to issue a tax exempt bond to be able to lower the interest rate? So with that sent us on an odyssey, if you will, to try to figure out how we could reassemble these puzzle pieces, meaning lots of infrastructure that has to be financed upfront, the structure that allows us more flexibility than would otherwise be available if we're having to go to the banks or go through traditional public debt markets. So that led us to start focusing on the municipal utility districts, or the MUDs. And so for those of you who are not familiar with MUDs, a MUD is a separate political subdivision that is established via the statutes in Texas that allow a separate political subdivision to finance streets to the extent that the MUD has road powers, parks to the extent that the MUD has park powers. Traditionally, the MUDs are financing water, sewer, and flood control or storm drain facilities. And they're a great financing tool. They've been utilized for just, I think, since the late 70s, early 80s. And they're one of the major workhorses in Texas on how Texas has been funding its growth. Now, the challenge we have with MUDs is that because MUDs are issuing general obligation bonds that are secured by an unlimited ad valorem property tax rate that is applied to the property contained within the boundaries of the MUD, the developer has to, number one, put in the infrastructure. They have to sell the pods to home builders that have to put in their infrastructure. They have to sell the homes, build the homes, close the homes, and get those homes on the tax rolls prior to the MUD being able to generate any type of increase in assessed valuation, at which point in time they can begin to issue their MUD bonds. As a result of that, the master plan developers, home builders are having to wait an extended period of time for them to be able to issue debt of any size that starts paying back the huge amount of infrastructure that developers have to advance to flush the first toilet, turn on the first tap, and sell the first house. So previous to this, the only way that a developer could potentially monetize and accelerate the receipt of what we're calling these MUD reimbursements, meaning infrastructure they have put in the ground that they are waiting for the MUD to issue debt for to reimburse them or acquire that infrastructure. So if you were going to a private investor and said, hey, we would like to sell our right to receive these future MUD reimbursements to you, what would you be willing to pay for your right to receive these cash flows? Depending upon what entity you're talking with, the private investors would be saying, you know what, we'll buy that income stream for a 12% discount rate. Then they would get in and they would look at the assumptions done by the financial advisors. They would look at market studies, et cetera. And typically what we've seen, at least in our experience, is that 12% discount rate, by the time they stretched out the bond payments and the absorption, turned in to about a 14 or a 16% discount rate. So it was very expensive money for our clients should they want to sell their future MUD bonds to a private investor to accelerate cash into the pro forma. So what we started to do is look at how we could get that sale of future MUD bond proceeds to be a tax-exempt transaction. And after 2 years of trial and error and working with the legal community and others in this space, we were able to create a new vehicle that we're calling the MUD Forward Funding Capital Appreciation Bond, which allows us to sell the future MUD bond proceeds on a non-recourse tax-exempt basis via a capital appreciation bond. And a capital appreciation bond, and I'll get into it in a little bit further when I'm talking about the specific transaction, is a bond on which there are no scheduled payments related to the payment of debt service. As the debt service comes in, it is being through the, in this case, the assignment of future MUD bonds. It is being paid down by each MUD bond in terms of accrued interest and principal until such time as it's paid off. And as I said, we're going to get into that in just a minute. But once we had a structure that we thought we would work, meaning we explained the MUD forward funding capital appreciation bond to a number of clients. And one of my good friends and developers in Texas believed in us, believed in this structure, and was willing to be the pioneer in this transaction. And I'm just so grateful to him. And by the way, he will be on. I'm going to keep his name a secret for right now until he comes on and talks about this specific transaction. But I'm going to touch on a little bit of it as it relates to our discussion today. But I'm really looking forward to having him on the Land to Lots podcast so you can get a feel for the trials and tribulations and successes that ultimately were achieved through this bond issue structure. But for this particular project, it was 406 acres. In the MUD, there were 1,063 lots that had been sold to 4 builders. All the backbone infrastructure, offsite and on, had been constructed. Roughly about $42 million had been put in the ground, and our client came to us and said, "Hey, Carter, we believe in this structure. Let's go forward and do it." So this process we thought originally would be 3 to 4 months. It ended up taking about 5 months. But what we were able to do is to go forward with the capital appreciation bond, issue a $35.5 million CAB. Our client was able to net out $33.2 million, of which the majority of that, roughly about 28 million, flowed back to them for costs that they had put in the ground. This relates to the $42 million that they had already expended. And $4.4 million was held back by the trustee to be expended over the next 6-month period to help them construct and complete their wastewater treatment plant. The coupon rate on this bond was 7.5%. So you can see that is dramatically lower than what private investors are willing to purchase. To entice bond buyers to purchase this transaction, the underwriters gave a slight discount. So the yield on the transaction was 7.76%. Here again, slightly higher than the 7.5%, but dramatically lower than that which MUD developers or master plan developers in Texas would be able to sell their MUD reimbursements via a private investor. So the structure of this transaction is that the $35.5 million bond, capital appreciation bond, began to accrue interest at the time the bonds were issued. What the developer had done was assign their right to be reimbursed to the MUD to the bond buyers. And so when the MUD, following the standard MUD TCEQ approval requirements, issues its bans or its MUD bonds, those monies flowed to the trustee. The trustee paid down accrued interest and principal until such point in time as the total par amount of the bonds is paid off. Once the total amount of the capital appreciation bond is paid off, the remaining MUD proceeds flow to the developer, very similar to any other type of mud that we see operating in Texas. Alternatively, should the mud developer want to go and issue additional capital appreciation bonds, we did set up the transaction so they could stack or issue additional bonds. We have an additional bonds test so that they could go and forward fund additional mud proceeds and accelerate those proceeds into their pro forma. So what is the real purpose of this, and what is the real breakthrough? The real breakthrough is that Texas MUDs are a great financing tool. Okay, they have stood the test of time, and they allow the development community to have a great deal of certainty that they will be able to ultimately be reimbursed for the public infrastructure and for the dollars that they're advancing for the benefit of the MUD, which is constructing the public infrastructure. With all of this as background, and with the closing of the first forward funding MUD capital appreciation bond, which occurred on June 28th of 2023, what have we done? So in essence, what has occurred is we have proven this concept, okay, and we have provided another financing tool available to developers in Texas that are utilizing the MUD structure to give them the opportunity, should they so desire, to advance the funding of their future reimbursements into the present time period and bring that into their pro forma to allow them to retire debt, to allow them to repatriate capital, to allow them to get additional capital to plow into future phases. So it's creating more choices for our clients. And I hope you find this interesting. I'm going to be bringing on to one of our future shows the developer of this transaction, so he can give you his insights as to what worked, what didn't work, what he sees as the advantages of this type of transaction, what his thought process was. And I'm really looking forward to sharing that information with you. But we wanted to get this out to share with the development community this new financing vehicle that is currently available in Texas. We can do the land secured financing launch bond anywhere in the United States right now, but the forward funding MUD CAB is really strictly a Texas tool at this point in time. And I hope you enjoyed this episode of Land to Lots, and I encourage you to share this episode with your colleagues and subscribe to Land to Lots on whatever platform you get your podcast. Thank you very much. See you next time.
You have been listening to the Land to Lots podcast with Carter Froelich. Follow us wherever you find your podcast to never miss a new episode.